Hello, welcome again. My name is Deji Nehan, a mortgage advisor and financial planner. I've been talking about roadmap to mortgage success, how to secure your dream home. We've talked about the pathways to your mortgage, which is your credit report. We've talked about understanding exactly what you want in the location or the type of property you want. So draw a checklist. Today we'll be talking about something very important, and this is about the money part. And what this is today is talking about the deposits. The deposits is one key factor in terms of getting your property. And you might have heard about loan to value. What that means is how much money you are putting down as part of the deposit, as part of the property, and how much you are getting from the bank. Let me give you a simple example. Let's say the property is worth 100,000, which is possibly not likely for a lot of people. But if you have 10,000, 10,000 would mean 10%. So that means as the owner of the house, you are putting 10% deposit down and you're getting 90% from the bank, which then term that as 90% loan to value. That means the percentage of the loan to the value of the property, 90 over 100, that's 90%. So that's the simple way to understand loan to value and deposit. As you would understand, the more money you put down as deposit, the better the opportunities or the better the lenders that are open to you. So let's imagine somebody wants to put down 60% deposit and the bank is putting down 40%. The bank sees that as a lesser risk and they more welcome that. And obviously they would give you some bonus for doing that. They will give you maybe a better interest rate, but you need to weigh out what it's in the best interest of you. So for a lot of people, they would want to maximize their loan to value. What that means is they want to put down as least as possible for them to get the mortgage, for them to get the dream house they want. It is not impossible to get the likes of 95% loan to value. That means you're only putting down 5% as a traditional home. But these days, within this post-COVID season, it's almost impossible to do 5%. But let's say things come back to normal, and I'll explain. The other way you could do 5% is to use the government scheme. The government scheme called Help to Buy. With Help to Buy, what that means is you can put down 5% and you could get 20% or 40% if you are in London from the government. And the rest, 75% if you are not in London, or 55% from the bank. So that is a way you can reduce the amount of money you are putting down. And some people might have support from maybe parents or their grandparents or someone gifting them the money for deposit, or someone could offset their savings account for them to use that as a deposit. So for some, it could mean that you can actually get 100% funding, which means that you don't need to put a deposit down. Either you are leveraging someone else's savings account or someone is gifting you the money. But there's one surprise I will give to a lot of people. A lot of people don't realize that some lenders would allow you to use a loan facility. Either you're getting a loan from someone or you're getting a loan from a financial sector, financial services company, and they would allow you to use that as part of your deposit. What they would need to factor in would be they will factor in the cost of paying that loan monthly on your affordability. So that's a trick a lot of people don't know, but it's possibly not the most advised option. But I'd just like to let you know that that's an option available. Either you're putting the money down yourself, or you're getting support as a gift, or you're getting a loan from someone. All of the two options, either the gift or the loan, they would need supporting documentation for you to be able to prove that this is a loan or a gift that you are not refunding. So that's quite an important thing to bear in mind. So, and then lenders might restrict who can actually give you that loan or that gift. One other thing people might be able to do is the fact that some deposits are called gifted equity. That means you have a parent or a grandparent that is gifting you. They don't gift you money. they gift you equity in the property. So let's say your parents have a property and they want to sell it on to you. They will gift you the deposit you should bring in. They will put that as a gift. So that's one area a lot of people are not aware of now. So I've given you 2 tips for you to think outside the box, and that could be, you could actually use a loan to get the mortgage. I'm not saying you should go that route, but that is something lenders accept in the UK. Or you could use a gift in equity from someone to be able to use that as your deposit. So the one very important thing to bear in mind in your mortgage journey is you need the deposit. So I've given us options to get in that deposit. It's important. You need to start planning for it, and you need to be able to prove it. It's called the proof source of funds. You need to be, you wouldn't expect that to just come in from thin air the day you want to complete. The conveyancing would want to see proof of that. Your mortgage advisor will want to see proof of that. Most times they would ask for your 3-month statement for you to be able to prove that. But if it's coming in an ad hoc manner, they might want to find out maybe the last 12 months how that has come into your account. So always remember, deposit will determine how much you can borrow. It will determine how much interest rate you get, and that is quite fundamental. And you need to start planning for that. So to get the mortgage success you desire, to get you to your desired home, to your dream home, think about your mortgage and start getting that ready. Or if you have any question about your deposit, let me know and I'm happy to answer your question. Thank you very much.